The growth trajectory for the Montreal Exchange, our derivative platform, just continues to grow. I think we have compound annual growth rate in that business probably in excess of 10% over 10 years. The type of growth in demand, there was a large disparity between OTC products trade side by each with cash, and essentially the derivative growth has been really taken on by some of our international clients. Canada is becoming a huge area of focus globally, and as our clients have been globalizing, we've been reaching out and providing very interesting liquid products to them as a substitute to some of the cash instrument that they've used in the past. Just to give you an example, this year I think our business is up roughly 66% in the first few months of the year, and our open interest, which is a huge sign of adoption, is at a little over 18%. So we're very excited about that. It's been a tremendous driver. 7 years ago, the Montreal Exchange basically had North American business hours viewed as a regional exchange, and the lion's share of the growth was coming from global clients. My background is OTC fixed income. We had seen that in the OTC fixed income, that demand for Canada was coming from abroad. So if you want your clients to deal in your products, you have to deal on their terms and conditions. And the fact that we weren't competitive relative to our global peers that were operating at 20 plus hours a day, we had to make adjustments. So we made adjustments in a first phase with our European hours. That brought in a huge surge in terms of activity. And then in the last few years, we basically completed the round-the-clock approach with our Asia hours extension. Our overall objective is that at the end of the day, we're going to see probably somewhere between 10 and 15% of our ADV generated by our international hours, our extended hours, if I could say. And so far, in some of the more liquid, tumultuous markets, we certainly are seeing our international clients prevail themselves of that liquidity. This has been an important sort of foundation to really build and create other product growth. And if if you're trying to look at your derivative products that are sitting side by each with your cash, you need to have sort of a competing product suite. We basically had two very, very vibrant products for many, many years, our STIR contracts and our CGB, which was our 10-year sort of key benchmark. We needed to fill in the curve, and that exercise was completed over the course of the last 5 years. We are also dealing with a very important transition away from LIBOR into a more risk-free rate, which the US has done and Europe has done. Canada is in the midst of this transition right now. So we've completely revamped the short end with our CORRA futures, 2-year futures, 5-year futures, 10 and now 30-year futures for a lot of the real money clients that are looking at opportunities to sort of hedge the back end risk. So that completing that full curve gives a lot of both our domestic and international participants an opportunity to replicate exposure that they would be able to in cash. So we're very excited about that. It's no secret that the pandemic brought out all kinds of traders, retail traders right across the globe. The US certainly saw that type of growth, and we did as well. Our options market had a couple of little quirks in them that made it a little bit more challenging. What I mean by that is we had a bifurcated market. We had an upstairs market for our institutional players, and then you had the more continuous market that was used for retail. If you want to have a very successful and very liquid options market, I think we felt we needed to make some tweaks on the market structure. We wanted to bring more global players into Canada. A number of the names that trade in Canada are interlisted with the US, and US with the type of market structure that it has and payment for order flow, although illegal in Canada, clients will basically route to where it costs them less to execute. So in a lot of cases, that flow would have migrated south of the border. We've really worked at revamping, finding solid liquidity providers that are providing very competitive pricing. And now on any given day, a lot of those interlisted names will trade more favorably in Canada than they would in the US. This is something very unique in Canada. We've been working with FTSE Russell, our partners, as well as CanDeal, in terms of looking at a very unique credit derivative product that would basically trade on spread. And in order to create this product, we had to have the foundation. I sort of set the stage talking about the work that we had done on our Government of Canada underlying futures yield curve. What you're going to see is a creation of an index with roughly 80 credit names that emulate, which is in probably 90% of the plan sponsors that are tracking Canada and are using the FTSE index as their reference. And this credit derivative will basically trade as a spread over whatever futures contract you choose to hedge. It's very unique. We've worked with the industry to try to design something that will be something somewhat different, and we feel that the adoption rate and the interest from clients will be very high. Globally, a lot of the central banks have put a lot of pressure to move away from survey-based, IBOR-based benchmarks to more volumetric, sort of reference rates that are risk-free in nature. Canada's transition, began probably 18 to 24 months ago. The Bank of Canada has basically said that at the end of 2024, there would be no longer any products reference or usage of CDOR. And it was established that CORRA, obviously the key reference rate that is replacing CDOR, be the de facto benchmark. So we're right in the midst of a transition right now. Members of the team, the Canadian Alternative Reference Rate Group, are actually roadshowing across the globe, socializing global investors around the opportunity here. And we're seeing some very, very good uptake already in some of the CORRA futures products that we've launched in order to help facilitate the establishment of the benchmark and establish liquidity in that product as well.